Welcome to part 8 of the Masterclass. In this video, I will be discussing how to see an exit on a strategy that you chose, or if you're in a trade for a longer period of time, when would the optimal time to get out would be. Okay, so I'm going to be using GBP USD for this video. And I'm just going to be picking a random point in time just so we can analyze where an actual entry would have taken place and where the sign of an exit would be. You know what would be actually significant? We'll draw it up where it's actually happening right now. So let's say, for example, this last few months, so the last 4 or 5 months, we'll take a fib, we'll draw it up from here to the low. So we can see it was kind of in the golden zone. It did a double top, not higher than the previous one. So a good entry would have been around here. Okay, EMA shift on the daily right there. Stop loss would need to be significantly higher. And we don't know how deep it's going, but right now let's just say as long as we get that 3 to 1, right? So right there. Now I'll switch it to the lower time frame to be able to see what was going on in this time frame, and I can tell you right now what I would see is a shift right here, and the trouble is that it would have popped up and probably wicked me to break even, but that's where my entry would have been if it's 60 pips. So nope, that's a little too tight. I would probably, it's a possibility that this would have been still a pretty good entry, and I would have tightened it to 60 pips and risked it. Whatever, let's pretend that was the case, okay? So what ended up happening is it dropped down about 90, over 100 pips. So stop loss would have been a break even, and it would have broken me out right there. Now, if I'd see another EMA shift and it's still all trending down, my entry would have been right there on that candle. Right, and my stop loss just a little bit above it, so I would say 60 pips would be very reasonable. Okay, great, so 60 pips, there we are, and 3 to 1 RR is right here, right about there. Okay, so that's my minimum tolerance that I would do to enter a trade and to see if it would actually play out, okay? So the only situation would be is right here, where you could see that it comes into profit again, and then it would hit stop loss again, right? So it becomes a little bit volatile when you try to go wick to wick, and doing that, the amount of stop loss that you have to break even once it's that much in profit. What I mean by that is if you set it to 60 pips stop loss and it goes 60 pips in profit, I would move my stop loss to break even. Right, so here it'd be broken again. It's very unfortunate. So being able to snipe this entry would be a little bit difficult, especially with those rules set. But again, if you want to just kind of risk it and it drops a little further, that's completely up to you. Right, even in this, we'd be able to see on the 1 hour maybe a tighter entry, if that is the case. Right, so what would we see here? EMA shifts, pops right back up. EMA shifted down on this candle, right? And maybe a tighter move right there. But again, it would have, stop loss would have broken you out there. And again, entry might have been snagged here. So whatever the case is, let's say, for example, we're just doing it off the 4 hour. We did exactly what we planned on when we saw those moves. Okay, so let's say entries there, the 60 pips, okay. And for all intents and purposes, we stayed in the trade, all right? So now what would happen to find your first exit? So number one, the first exit that you have is the TPU set, okay? If you're aiming for 3 to 1 every trade you take and it hits your 3 to 1, you're done. That's your first exit. Don't jump back in, even though you see that it could possibly continue, okay? That's sign number one. Number two, EMA shift. What I mean by that is when the yellow crosses the red line on your EMA. You can use, your DeLorean. You can use your Fibonacci EMAs, whatever. I prefer Fibonacci, but it doesn't really matter because both DeLorean and Fibonacci have the 5 and the 13 in their settings as standard, regardless. Okay, so once they cross, that's a good sign for an exit. So let's say we entered on this candle, and then it finally crossed right here. So that would be a bit of a loss, right? Even though it was trending for a little bit. Now, so again, they are also entries and exits, but when we determine the ultimate trend, we're not going to be jumping in counter trend, right? That's a terrible idea. So anyway, determining the second exit, which is the EMA shift. As you can see here, yellow and red are parallel and they start kind of bunching up. Do they shift right here on the 4 hour? No, they do not. It drops a little lower. It finally shifts at the end of this candle, this one right here. So we could bring that long position all the way down to that close, because exit once it closes, not before, because look, you can see here if you'd exit early, you'd miss out on that entire run. Okay, so still pretty good, 228 pips, and that would still be a 3.79 risk to reward ratio. The only situation being is if you waited for that EMA shift instead of your TP, you'd be in this trade an extra 5 days and 16 hours, so almost 6 days worth of trading time, only to make the exact same TP, basically, right? So where the TP hit here and then where you exited there, it ends up being almost the same. The only situation is your 3-to-1 would have been, you got a little bit more and you stayed in for much, much longer, right? So you got 3.78 instead of 3. So still okay, but you're in the trade much longer, okay? And once it starts consolidating, it could be, for some people, it could be very arduous to stay into a trade that begins to consolidate, because at that point, you don't know if it's going to be going up or down. That's why I would say analyze on larger time frame. Anyway, so exit number 2. The exit number 3 is if you still don't believe that that is cause for you to get out. The third one would be on your MACD. So if your signal line crosses the histogram, right? So we can see the histogram peaks right here and then it turns red. So I mark the 0 line right here with a nice thick black line. When my signal lines, which is the white and the green or the white and the red, depending on where it's on the chart, once they cross that 0 point, that is my third and final indicator of when to get out of the trade. All right. The reason why I would say it's kind of the final indicator is because there are times where it could bust through a Fibonacci EMA. There are times when it doesn't even come close, right? And, maybe the 618, it could happen that this big wick is your threshold and it kind of breaks you even, right? Depending on when you entered the trade. So while I say it's the last one, as you can see here, it never broke that 0 barrier. It just kept going back down. So this, if you would have used the MACD as your final exit and it didn't trigger, your trade is still valid. Okay, on the larger time frames, as you can see with the MACD, okay, when we would enter, no contest, right? It's still going down regardless of what you see here on the lower time frames. That's why if you snipe an entry on the 1 hour or the 4 hour or possibly a smaller time frame, and then you're in it for a little bit and you see that your risk to reward is a 2-to-1, move it to break even, switch to a larger time frame, and then you can analyze, hey, you know what, this is trending very well. There's no chance that I see this crossing anytime soon, right? It would take several days at the end of this candle to actually turn back up. And what are we seeing? Nothing of the sort, okay? So what we drew up of the Fibonacci originally was right here, the reversal area, waited for an EMA shift. The best time would have been at the end of that candle, right, as we saw in the lower time frame, less volatile. And then what we can do is now analyze with a trend-based fib extension. So we had the high here, we had the low, and now the next high. So my potential exit would be right there. Now you see this almost hit that spot. If I saw that happen and it pulled back up, I would have probably taken the exit, because that is incredibly close. Too often have I seen this happen and then it just reverses much higher, right? So Again, if you do that kind of analysis and you got out at the end of the candle, you just got an 8.69, so 8.7 to 1 risk to reward on a pretty solid trade that lasted you for a few weeks, right? So your entry would have been there, your exit would have been there, so 21 days, exactly 3 weeks worth of time to be in on a trade, and it profited quite nicely. Okay, so let's just recap. First sign of exit, EMA shift, TP. When you hit your TP, trade's done. Second sign of exit, EMA shift, right? If you want to let a pair keep running after you've entered it and you don't have a TP set, that would be your first indicator to get out. The third indicator, or second if you didn't set a TP, would be the MACD signal line shift, right? So you can see here, it started climbing, it finally broke the threshold around that area, and then it dropped once again, okay? Now, when you would analyze, you would see that, hey, it just pulled up to the 618, it didn't quite exit, but then, I mean, this is if you're taking a trade that's going to last a year. Most swing traders aren't going to be in a trade that long, guys, so I would recommend looking for these kinds of things, the reversals, right? Because once you had, in your original trade, you jumped in on an EMA shift, which would have been on this candle, right, just as an example, and you kept going, you know, it pulled back up, so that would have been pretty rough, but there was no EMA shift, right? The trouble, as you can see, if you'd entered from here and dropped all the way down, it pulled back past the 618. You know, so for me, that made me a little bit nervous, especially on the daily, but look, sharp pullback, right? And then what happens? Engulfing candle down, little consolidation, and drop further, right? But you can see the EMA never shifted again, could have stayed in there much, much longer, especially because break-even would have never been triggered. But to give up 558 pips and for it to go all the way back up to 84, that would have sucked. Okay, anyway, doesn't really matter at that point in time. All I'm saying is when you finally get from that peak and you get that 618 that you've been looking for, right here, almost anyway, okay, there is a very strong chance that it's going to continue down, especially when you look at the larger time frames and everything is pointing down. All right, so like I was saying, first is TP, second is EMA, third is MACD, and your fourth potential exit is going to be, what is it going to be? When your final indicators are broken through, okay? Now, I gotta tell you, to be in a trade that long, probably not a good idea. All right, the first three will help maximize your profits. If you're waiting that deep and hoping that it's gonna pull back exactly as you expect, I mean, you know, you might be in a trade an extra month or two just to be able to recover the profits that you could have potentially had a month ago. Okay, and it's not really worth it. Like, look at this, for example. If we saw that this was dropping and an EMA shift happened here on the daily, that's 56 days. That's almost 2 months that you were in this trade, right, from that peak, which not even the case. It would have been right here on the EMA shift, and then when it shifted here again. So you would have made 487 pips in 43 days. Okay, now it keeps pulling back. What are the chances that you're going to stay in this trade past 43 days, hoping that it hits off the spot that you're looking at twice, right, because it pulled back 2 times, and then finally be in a similar profit that you were? That's 70 days later. That's a month longer than you should have been in the trade to begin with. Because even at that point, you could have reanalyzed and saw, hey, there's going to be a good entry here too, with a tighter stop loss, right, as we saw if we dive in on the 1 hour. Right, and we zoom in and we see, oh look, after all those shifts, there's a pretty decent EMA shift right here on this candle. The highest I'd want to go to is there, but I can see that this is dropping. I'll set my stop loss maybe to the white EMA line, which is 37 pips. See, tighter than the 60 that you would have taken there, and now look, just staying in there for a little bit longer, you would have been great. And again, if you would have been in and wicked you out, I would say, hey, you know what? Wait to see if that wick gets touched again. And sure enough, entry could have been potentially right there. Maybe with a tighter stop loss with that EMA line again, right? So greater risk to reward ratio at that point. So everything really depends. The best way to maximize your profits on swing trades is off the 4-hour time frame and off the 1-hour time frame for entries, on the daily to determine your overall trend, and using the daily, the 4-hour to determine when you want to take that exit. Okay, especially when you're in that much profit, using a small time frame, you're going to be jumping in and out of trades like 3 times a day. I do not recommend that. Right? There is a much better way to maximize profit, and that is to stick into a trade on a larger time frame. As you can see, right, EMA shifts here. What's the chances it's going to peak at that point? Like I said, you just need to know your risk tolerance on a market structure trade. So the highest I would take a stop loss, 89 or 90 pips, right, just above that wick. And when does the EMA shift first happen? It would be right about this candle here. You would get that exit. All right, so you see that if you would have set a 3-to-1 trade, right there, okay, 89 pips or the 98 pips like we showed before, it's pretty large in my opinion, right? And the thing is, if we would be able to snipe an entry, it would be a lot greater as far as a risk to reward. But even still, right, you can see that that 90 pips right there, it would have taken 4 days and 20 hours, so almost 5 days to get in profit. Whereas staying in the trade an extra 3.5 days only to lose 73 pips, or no, only to lose, how many would that have been? Right from that line to here, to lose 43 pips and be in the trade 3 days longer, it's not really worth it, is it? So always practice that 3-to-1 for your exits. Once you start getting confident in those trades, that you're hitting your TP, those 3-to-1 trades more often, then I would risk maybe letting the trade run a little longer, right? However, you can also let it run longer while taking your partials already, right? So if you hit your 3-to-1, maybe take 75% of your profits and let 25% ride. And if it, you can see it a month later, and if it rides pretty well, move that stop loss where you originally grabbed TP, so that even if some reversal happens, you have nothing to worry about, right? You still kind of break even in profit where your trade ended originally. But if you see another EMA shift right here, that's a potential, let's see where it's at. That's a potential 5.25 to 1, right? But then you are going to be in the trade for a long time where that candle shifted, you see? So that would have been a total of, where are we at? Right here. 19 days and 12 hours, so almost 3 weeks, instead of taking original TP where it was right, where was the 300? Somewhere around there, after 4 days and 20 hours, right? We said it was right at the end of there. Okay, so yeah, I mean, you'd be in the trade for 3 weeks instead of 4.5 days or 5 days. But at the same time, after you see another EMA shift, here's another potential entry, right? So you see where the trouble begins. 152 pips for a stop loss is really high, okay? Unless you're swinging crazy amounts of money, I don't think that's going to be profitable in the long term, unless, again, you're in the trade for several months at that point, right? So this is where I would be like, okay, let's see what's going on in the 1 hour. Here we go, shifted right there. If I'm taking an entry at that candle, maybe right there, so 125 is still a bit too rich for my blood. I don't know if I'd want to be taking that kind of stop loss. Okay, best would be if that candle ended, maybe the top of the wick, let's see, 115, still a lot, right? Because as you can see, this wick beat this previous one, so that doesn't really tell me that this is going to be going down after I see that, except for that very long candle. So taking the risk here, right, and only risking maybe up to half the candle, you have the potential of losing that trade. So guys, just to recap, 4 potential exits. TP is number 1, EMA shift is number 2, MACD indicators and signal lines is number 3, and the 4th potential exit would be getting stopped out. Not the one that you want to hear, but that is the 4th potential exit, right? It's the one that sucks. We don't want to be getting stopped out of our trades unless they are in profit. Okay, and that's if you just moved it up too soon. You know, I'd rather take a stop loss in profit than a stop loss as a loss. Okay, hope that helps for entries and exits and what to look for. You know, once you get better at your strategies, there's going to be a very strong potential that you'll recognize your own entries and exits, maybe not just in this market structure, but you'll want to exit when you see a specific candle pattern. You know, when you see engulfing candles, you'd be like, yeah, I'm out, that's it. You know, that's where I'm taking my exit. I'm not going to wait for that run up. Okay, because now look, even, I know I'm jumping in again, but now watch this, right? Even if you enter at this candle, like I said, to the top of that, 37 pips, right? To the bottom of this guy, it's 135, but this is where the big engulfing candle closes, so it's still 81 pips in profit. You know, and what was it, 37 pips stop loss, right? So that's still a little bit more than a 2-to-1, right? So here we go to there, right here. That's your exit. So 2.2, 2.1 to 1. You know, still not the worst thing. If you were hoping for a large run down, you know, that would have been pretty good. But another potential would have been if you took the entry and then you see this giant wick happen, and then it probably would have broken you out, right? So very unlikely you would stay in that trade and risk this going to a stop loss if you were already more than, you know, 1.4, or I would say even more than 1-to-1 ratio in profit, you know, to stay in that trade. I don't know if I'd want to do that, right? The only time I would is if my risk tolerance is 55 pips. So if I'm, you know, you can see just 55 pips in profit, I probably wouldn't have moved it if I took that entry higher, right? So just be careful with these exits, okay? Just focus on doing one of those four, right? Those are your best case scenarios for still making some profit while you jump into a trade and you are profitable. Don't move your stop losses too early, right? Wait to be in that profit zone first before you do, because as you see, there's a very real chance you'd be breaking out of your trades early, right? If you move the stop loss too early. Even so here, right, there's going to be potential chances like this where, yeah, you go into profit and then it breaks you out, and there's going to be chances like this where it just keeps going, right? So, you know, you're not gonna win them all, but certainly what we want to mitigate is the amount of times you lose. Okay, breaking even is much better than being at a loss every time. Being in profit is the best case scenario, right? But if you can't be in profit and you can't break even, and you think the trade is kind of lucrative to enter, don't trade. That is the best position you can be in, is no position. Make sure that you only take entries when everything lines up in your analysis. Don't be hasty. Patience is going to be your best friend. So I would definitely recommend the next masterclass I do. It's going to be on mindset, specifically on patience, and kind of to avoid that itchy trigger finger, to make sure that you don't jump in on trades prematurely. Okay, so thank you very much for watching, and I'll see you in the next video.